Hi, this is Brian Dolan with the law firm Pepper Hamilton. Thank you for listening to this podcast for investment management and hedge funds focusing on the evolution of blockchain. Recently, Pepper partner Greg Novak hosted a webinar for West Legal Ed Center. He was joined by fellow partner and head of Pepper's technology practice, Joseph Guagliardo, and of counsel Todd Kornfeld. Together, they discussed the evolution of blockchain and examined its potential use in creating a secondary market for peer-to-peer loans and for eliminating the bank payment processing system. If you're interested in downloading the PowerPoint slides from this session, visit Pepper's Insight Center at www.pepperlaw.com, where this podcast is posted. Thank you. We hope you enjoy the session.
Thank you very much, and welcome to our monthly investment management discussion of great topics of the day. My name is Greg Novak, and I am a partner in the law firm of Pepper Hamilton in the Financial Services Group. I split my time between New York and Philadelphia, and today I am joined in New York by our fellow panelists, my colleague Joe Guagliardo, who is a partner in our intellectual property practice group, Todd Kornfeld, who's of counsel in our Financial Services Group, George Popescu, who's an entrepreneur but also very knowledgeable about our topic today, which is blockchain, and Charlie Moore, Global Debt Registry, obviously confirmation of what this is and how it works, and the importance of the ability to verify what you own and when you own it is part and parcel of the adoption of this technology. We are going to talk about blockchain, not so much Bitcoin, because Bitcoin is just the current manifestation of it, but rather why large money center banks are spending millions of dollars to explore blockchain and its potential use. Why some believe that blockchain will provide for secondary markets in esoteric assets. Why there is such a stir right now about blockchain as a potential game changer where you telescope down from T3 to T0 in terms of settlement of securities trades. And, of course, you also have the skeptics who say it'll never happen, it's 10 years away. Maybe, but we at least need to understand what it is and then be prepared to spend money. Because it seems to me that after our prep discussions that anyone who's going to participate in this industry is going to have a significant technological and cybersecurity spend before they start realizing significant benefits. So without further ado, I'm going to ask George Popescu, who's worked in the trenches with blockchain, to introduce what blockchain is and, a general idea of how it works.
Thanks, Greg. So best way to think of blockchain is that it's a record, it's a ledger of digital events which is distributed, which means, for example, in the Bitcoin case, there are 7,068 copies of the Bitcoin blockchain around the planet. Every single such location is called a node typically, and each node has the whole history of all the Bitcoin transactions that have ever happened from the first one. And this blockchain can also be imagined as being a database, is being updated by adding a block every 10 minutes in that particular case by a majority of the computers, and it can be rolled back if they don't agree. And having this distributed database ledger where anybody can see while it is anonymous poses a lot of problems along order of transactions and voting who owns what.
All right, so let's take a step back because I think we got immediately into the weeds. And by the way, to those of you listening, you will find that you get into the weeds in a nanosecond in this topic. Let's take a step back. First of all, who is running blockchain?
Oh, sorry about that. So it's run by software on computers. There is no actual human who has to take steps to run it.
Okay, but how does a computer or a person who owns a computer all of a sudden start to participate in this? Did they just say, I want to be a node?
Yes. They
That's it.
have to download, and they have to say, I want to be a node. That's it. They don't have to be approved. They don't have to be registered. They don't have to be going through any AML or KYC or anything like that.
And is there any requirement when you set up a node that you have capital, that you have any qualifications? You just need to have a computer with enough computing power to be able to operate this system.
So we're talking about the particular blockchain of Bitcoin, right? In which case the answer is yes. Anybody can do it anywhere on any machine without any qualifications whatsoever. Now, these rules can be changed for other blockchains, and you can put requirements on this.
So that's a very important point. There's more than one blockchain out there.
There's as many as you want. People can create their own at home with their family.
And a blockchain can be public as well as private or limited access?
Yes, they can.
And how secure then, once it's limited, is that access?
So the ones that have been the most successful so far have used cryptography, the standard internet cryptography for security reasons.
So that means somebody needs to somewhere have a key that tells them how to get into this particular blockchain. Now, can't that key be hacked? I mean,
and it has been plenty of times. If you look at some big heists around blockchains, there already have been $400 million worth of heists on the Bitcoin blockchain.
Bitcoin blockchain. So what we're talking about is an open distributed ledger that anyone can raise his hand and say, my computer is available, I want to participate in this particular blockchain, and assuming it's a public blockchain. If it's a private blockchain, then presumably whoever authors it puts on some form of qualification requirement. So, for example, you could have a blockchain of prime brokers in a bid-ask scenario where they are going to provide the borrow insurance, or they are going to otherwise do the things that our investment management clients are looking to do.
Absolutely.
When it's a private, how does the private blockchain work versus a public one?
The rules are not set. Everybody can decide how the rules can be implemented, but an example would be that all the participants have a key, and the only way to get the key is from the generator of the blockchain, and unless you have a key, you cannot participate in the blockchain. And the only way to get your key is by meeting face-to-face and being handled electronic device, let's say USB key, with your cryptographic number, that's your cryptographic key on it.
So that becomes your cryptographic key. Todd.
One difference is in a public blockchain like Bitcoin, those nodes to do the mining, they're doing it for an incentive. They get paid when they verify things. In a private blockchain, you generally are not going to get paid if you're a node doing verification. That's part of your business, right? So you give JP Morgan and Citi and Chase, like a three-bank private system, they're not going to reward each other for verifying the data. It's just part of the cost of doing business. They'll do it for free for themselves.
But verifying the data is so crucial to what they do that it's very important to know who the buyer, who the seller, and the amount is.
Right, but the motivations are different. They don't get paid for doing it as such, whereas in Bitcoin, you get paid for doing the mining, the verification, and that's why people want to be the nodes.
With the incentive to be the node.
Yeah. The incentive in the private, if your bank-to-bank thing is you want to make your back office function better, and therefore you do the verification for free as part of your process.
And I think, Charlie here, a key difference between sort of the public Bitcoin blockchain and the private blockchain examples that we're starting to talk about is in the private blockchain scenarios, there's still likely going to be a need for some form of intermediary to help set those standards, decide who's getting a key, and it's not going to disintermediate every single entity, in the middle of these value chains. There's still going to be some role, albeit a more efficient role, for somebody to be the gatekeeper in providing access, ensuring what is private, what is open content, and setting data standards and rules and so on around the usage of that blockchain and the applications that are effectively sitting on top of that blockchain.
But Joe, I've heard blockchain described as, if you know how real estate title works, there are these big books in the county assessor's office, and if you're not in the quote-unquote chain of title, then you don't own the property. You're completely ignored. And these books go from the prior owner to the next owner, and basically it's a very cumbersome system. Most localities have already computerized that, so it's much easier to search title and get a complete record of the historical title back to the land grant from King George III or whatever it might be here in the United States. So I've heard blockchain described as an embodiment of that. How does that work?
Yeah, one thing to think about, and you had mentioned this about sort of how do you get access to it, there are, at least in the Bitcoin implementation of it, there's a public key that everybody who's a node has access to and allows you to read and get access to the blockchain itself. But in order to actually have something of value and to represent something on the block that represents either Bitcoin or, in your example, a piece of property, you also have a private key. And so in order for you to write to the blockchain, you need to have both. You need to have the private key and access via the public key.
Okay, but who writes these keys?
So the keys get, and that's essentially what the nodes do. I mean, the nodes are essentially verifying that when someone is proposing that they have something of value and they want to write and add to the blockchain, the nodes will verify that that transaction is in fact valid. If they disagree, that particular block is not added to the chain.
This sounds like a bad science fiction movie,
Yeah.
I gotta tell you. But basically what we're doing is we're decentralizing the verification of ownership. And what happens if, 50, 100, 200, 500 of the nodes disagree with the other 5,000?
So there are multiple copies of the blockchain floating around, at least in the Bitcoin example. And the blockchain that is the longest is the one that is valid. So it has the most blocks that have been verified. And so if for nodes to determine which one is the right blockchain to be looking at, we look at the actual longest chain.
Now, but this has to take up an enormous amount of data and bandwidth. Is it going to break the internet? George.
So there is an article written with some calculations that shows that if things continue at the present speed, the amount of electrical power needed to make Bitcoin work in 2025 will use as much energy as the whole country as that of Denmark, which pretty much means it's extremely inefficient.
Right. So paper's better, right? Currency?
Absolutely.
George, you gave us a graphic, which is the second slide in the materials. Could you explain exactly what we're looking at here, how this is to be interpreted?
So the idea is that blockchain can be used to get rid of a lot of the intermediaries who serve as central authenticators of, let's call it ownership. And by implementing blockchain in different markets, people expect, in capital markets maybe, or maybe in other markets, that instead of having one central party who will say how much each of the participants own and who owns what, when, and how, instead, every single participant in that market will be able to know in real time, within minutes, how much and what every single other participant owns. And all of this will be done at a much, much cheaper cost. And that's what drives this entire thing. Cost.
But if we're using as much power as this country of Denmark, I mean, that can't be cheap.
Correct. So not all the implementations are as efficient. I think we're not done implementing better blockchain models and more technologies. People like the Ethereum Foundation are trying to come up with more efficient ways of building the blockchain. The main problem that's there, and it's using so much power, is trying to solve the problem of timing. If I write a transaction on the blockchain to user A, and then I write a transaction to the user later, a minute later, I write a transaction to user B, it's important that A happened before B because of my balance in my account and things like that. And that's what's using so much computing power.
For like high-frequency trading activities where you've got very time-sensitive information and high volumes of data, it may be less appropriate than some of the lower frequency.
But you think that would be on a private blockchain, which might make things easier.
Yeah.
What makes it very hard in the Bitcoin is that there's only one blockchain for all the Bitcoin transactions across all the globe, across all the participants, everything. And as we were talking earlier with Todd, just the speed of light around Earth limits how long it takes to transact information.
Actually, that's a really good point. That's one of the differences between consumer transaction processing and specialized applications, like in the wholesale market. And if you want to be able to go and access your bank account on a global basis, the blockchains are going to be, by definition, very, very large, because there are millions of accounts, hundreds of millions of accounts that may be on this blockchain. It's a very big blockchain indeed. If you were talking about a hedge fund or an asset manager or somebody else in the wholesale market, they may have their own private blockchain. They share 50 banks. It's a lot smaller. Right. It's getting shuttled among a much smaller number of nodes that are known in advance. The performance may be very, very different. Scalability may be very, very different.
Right. So in our use case, at Global Debt Registry, where we are focused on consumer loans in particular and the validating and tracking sort of the ownership and whether the assets are real enforceable asset, in the grand scheme of the markets we've just been talking about, it's pretty low volume of loans. There's pretty low volume of participants. You know, really there's only 20, 30 platforms that are originating loans at any significant scale. There's half a dozen warehouse lenders providing a lot of the credit, and there's 20, 30, 40 investors who are investing in most of those loans. So you're not talking about thousands and thousands of participants. It's a pretty small universe of players, and it's pretty low frequency in terms of the investing and buying of these loans. So it's not vast amounts of data and it's not vast amounts of players, but it has got a challenge in terms of trust and having one view of you know, whether the asset is real and that's the record of it.
Imagine a blockchain that tries to incorporate every checking account in America.
It's not manageable.
Yeah.
It's not tractable.
Yeah. Well, it's also not private.
Right.
Is a big issue.
Right. But you'd have Bitcoin. You'd basically be making everybody use a Bitcoin-like thing for their checking account, right?
It's not going to work.
Yeah.
So I was doing high-frequency trading, and everything we were doing was co-located at NY4, Equinix data center, between the banks, the participants, everything. Now imagine if all the blockchain nodes were in the same data center, cross-connected via cables between hundreds of participants. That's tractable now.
Yeah.
Much more implementable.
Turn to slide 6. There's a very complicated trade, and the value proposition for post-trade settlement process. And this is with thanks to Fujitsu. But you start, if you will, with the pink box, the asset manager, who wants to place an order. He places that order with his local broker-dealer, who then places the order with a Japanese broker-dealer. Japanese broker-dealer sends the order to the exchange. The exchange gives notice of execution. It comes to the broker-dealer. Broker-dealer sends it to its correspondent broker-dealer. It goes back to the asset manager. The asset manager then, through his agreement with the global custodian, gets the trade notice, and then gives the global custodian settlement instructions to the Japanese sub-custodian, and there's settlement between the sub-custodian and the broker-dealer for this trade. So all the way around the donut hole, if you will. In the center, you see all these lines where the blockchain, in a sense, would, instead of having this around the daisy train transaction, essentially have the asset manager go directly to the exchange, and then that trade is then verified by all the party participants. Is that the right way to read this, Todd?
It's one way of looking at it. I think
the straight-through processing, cutting out the middleman, going direct to the exchange, and because we've just made a trade, the constituent parties who have an interest, the global custodian, the sub-custodian, the exchange, all then match everything
You're basically you're creating a database entry that everybody can see. Okay? So whoever sold me this...
Sort of like an open book swaps exchange facility.
Right.
Okay.
So everybody who has to see it can see it. I could still make it private because of the nature of the participants. I could say it can be seen by there's 50 trusted custodians in the world and 500 trusted brokers and blah, blah, blah. So I can limit my universe, which helps my security and helps my performance. But ultimately, the key behind distributed databases, everybody can go and see it, and then they can go and update it appropriately with the right information. That's the idea. And instead of having to go through one particular node or exchanging from party A to party B to party C to party D, party E to party F, and people aren't kept up to date with what's going on, right? If you think about it. The beauty of the blockchain is everybody can see in real time or close to real time. All these participants can see what's going on this trade.
Well, I mean, international trade settlement has been going on for centuries, right? We have examples of the Knights Templar from the Middle Ages, and then the one that you brought up earlier, which I thought fascinating, the Hebrew traders.
Yeah, the Jewish communities across the globe doing trade finance basically by writing private letters to each other, saying this guy owes me money, please collect it from him, or please advance money to this guy. The community in Syria will pay back the community in Beijing or Confucius in China. That is around 1,000 years ago, and successfully too. These are not new ideas at all in that sense. But Bitcoin or these sorts of blockchains in general, in some ways, are just newer implementations of old ideas.
Right. Yeah, Joe.
Yeah, I mean, I think the 2 points about this slide to make are, as Todd mentioned, it does solve the problem of shared facts, right? It enables all of these parties who are involved in this transaction to see the material facts of the transaction at the same time. I think the other point is, and we get into the sort of the smart contracts concept, which is taking Bitcoin and adding some dimensions to it, and allowing, and smart contracts not actually a legal agreement, but it allows the execution, sort of the self-executing aspect of multiple agreements that are made up of this donut, as you called it, right? There are multiple parties and multiple agreements. If you have the ability to execute some of these trades automatically based on a set of rules, have them self-executing based on rules and certain triggering events, it would simplify the process, or at least continue to keep the process moving with arguably fewer errors. I think that's the goal.
For example, if you're doing credit default swaps on the blockchain, you might know every single one that is on IBM credit. And then if a credit event ever occurs, there may be a process in the smart contract for automatically flipping. There's been a credit event on this entry, and every other entry that's just an IBM credit default swap in the blockchain. Things like that, which might make settlement easier and record keeping easier, and everybody can see it.
Everybody can see it, but there's no central repository, nor is there an exchange thing in the middle to make sure that settlement occurs, which was one of the big reforms from the Dodd-Frank Act.
And my suspicion and belief is that in a lot of these markets, ultimately, the blockchain will wind up ending or being copied into becoming part of somebody like DTC. In the swap market, if for no other reason, a swap data repository, for example, they would have to be copying this stuff down. That's not a clearing function, it's just a record-keeping function. But I can certainly see, from a clearing perspective, anybody, whether it's CME or DTC, who are heavily involved in industry efforts in this area, will probably ultimately wind up being the place that, in some sense, is trusted keeps the data, which in some sense turns blockchain into something else, which is it becomes a quick real-time system for getting your trades and processing done. But by the way, it ends up in a single centralized database at the end of the hour or the end of the day or the end of the minute. And then maybe what really ultimately happens, and that's your clearinghouse.
Well, but to break that down a little bit, what you're really saying is that there's a difference between the price discovery, counterparty discovery function and the settlement.
Yeah.
And basically you're still focusing on blockchain as essentially facilitating that top layer, but that still there must be somewhere, somehow, something that owns the asset, holds the asset, and acts as the global custodian. So let's flip the page to the next slide, which is the smart contract, which I guess is the next manifestation of blockchain. George.
So the smart contracts come exactly in line with what you were saying there, Greg, which is they enforce automatically actions that are coded in the blockchain. Here's an example of smart contract. I make a software which I put in the blockchain that says every single time somebody sends me $1, I send them $1.10 back. Called a Ponzi scheme.
Yes.
This is a smart contract, and you can code this in the blockchain and make it run automatically until it runs out of money. And this happened to be live, and there are existing smart contracts who have been implemented, who do all kinds of things, and who, in a nutshell, automatically enforced actions that have been coded using digital assets. We have to make a difference in smart contracts controlling digital assets and smart contracts controlling physical assets.
Well, but the whole point of it, when you say a digital asset, I can take the title to real estate and digitize it. The real estate still exists at the corner of 8th Avenue and 42nd Street, right? It's still real estate. It's still there. However, the ownership of it can be traded digitally. Just like I can do the same thing with shares of stock that were done back in the 1960s with the advent of DTCC, right? We have a central depository holding the asset, which then decouples the settlement and custody from the ownership.
I think the example that you can think of, on the settlement side is you could say, fine, let's have a series of blockchains that handles government bond trading among hundreds of market participants, dealers, right? But at the end of the day, when it becomes 4 o'clock and they want to settle with each other, does JP Morgan want to have to go send wires out to 1,200 dealers across the world? Or do they want DTC to say, we've netted all of your position with every other participant, and you owe DTC $2.57 today?
Or is it more likely what the ultimate goal here is that there would be integration between the wire function and the trade, so that when the trades are completed at the end of the day, the ownership of the asset would have already and the actual asset would have already transferred as part of the smart contract. So there is no need for the 1,200 wires to be sent out. I mean, you're still thinking, I think, of the settlement function as having a central repository of the ownership of the asset. But I think, if you truly are visionary, you go to the next step of what blockchain could become. The blockchain itself could be the embodiment of the digital manifestation of the asset, right? Without having to have a central repository.
Greg, what are you settling?
What's that?
What are you settling?
I'm settling by electronically transferring the ownership of the blockchain from me to you.
Right.
And because all of the nodes agree that that is a real thing,
right,
that you now own it, I don't need DTC.
But am I still paying you cash?
Or you may be paying with cryptocurrencies.
Right. You could do all that, and I agree with you. But I think ultimately the issue you're still going to have is, whether it's cryptocurrency or U.S. dollars or pastrami sandwiches, you're going to have a large number of payments across your nodes, right?
Or automatically the blockchain debits my account, wherever it might be.
Well, you could build a replacement for DTC with one giant blockchain, right? Where that blockchain keeps a running total of who owes.
Now we're using the power for the country of China instead of Denmark.
Exactly. But that's buildable. I'm sure it is, but there are other practical problems. But I think the question ultimately is, and this is a big issue people have thought of, that centralized clearing houses or things like DTC, will disappear in a puff of smoke once this blockchain stuff comes out. And in reality, it's more likely DTC and people like them own the blockchain technology and control how it's implemented and used, at least in the markets DTC cares about. And if anything, they're likely to be a stronger player when it's all over. We know from public press releases that many of these organizations like Market and DTC and CME are heavily involved in R&D and projects in these areas. So it's not likely they're going away.
Joe. Greg, to go back to your example of the real estate settlement, it gets really interesting when you start thinking about all of the different players in a real estate transaction. It's not just the buyer and the seller who hold the title. It's the seller's bank that may have a security interest. It's the buyer's bank who's going to have a security interest. Right? There's a title search company. There's all the parties that are involved in the transaction. And if you eliminate the central party and you have this all residing, sort of back to my point earlier about shared facts, you have all this residing and all these parties are tied into it. They have the information. They know when the title is released. The seller's bank releases its security interest. The buyer's bank issues its security interest, and then then it gets interesting because everybody's on the same page about the facts that are available.
And interestingly, we're starting to see land registries emerge that are specifically built on the blockchain in South America and in Africa.
Emerging markets.
They
don't have all
the infrastructure, legacy infrastructure.
Right.
They've got the county deed recording offices and et cetera, et cetera. So I think ironically that it may well be an emerging market that we see some of the best practice in that area.
So what does that mean? That means the cost of closing is going to go down from being points on the cost of the house to maybe basis points. What that means? It means that if the cost of the house changes by points across a year, you can buy and sell the same house intraday.
Well, I don't know necessarily if the cost is going to go down because usually the biggest part of the house closing points is the concession you pay to the bank in the form of upfront fees, and the banks make huge amounts of money on the points that you pay on the mortgage.
And the loyalty to your sales contract, which may be negotiated.
Yeah. But then the other big component is title insurance. Yeah. And the reason why there's such a fee there is there's a premium that's incurred that you have to pay to the title insurance company to insure the title. It would seem to me that actually may go up when you're dealing with something like the blockchain, which may or may not have the same degree of certainty that you have right now in a system that's been around for 400 years.
Should improve certainty and drive that price down, I would like to think.
So let's assume myself, I
bet you dinner on that.
It may take us a while to prove it out.
There's actually a real world example. United States, Massachusetts, I don't know how far they got on this, basically tried some humongous project 30 or 40 years ago to basically go through and quiet title the entire state. I mean, there would be a good quality registration statewide of titles. You probably wouldn't need title insurance, frankly, when they were all done with that. I'm not sure how well that project went. And the blockchain on an international basis, for new things that might be fine, but the problem is, so you're buying something in Ecuador on a blockchain with 500 years of title history back of it, which is not on blockchain. So unless the government wants to say, we guarantee the first entry in the blockchain is true and correct, and there's good, clean title at that point, right? Unless they're doing that, this doesn't matter because you're only incorporating the new history into the blockchain. You have to go back and clean up the 500 years before.
Yeah, and truth be told, and not intending to disparage, the government of Ecuador, but I am concerned about, many of these countries and whether or not they have the stability to be able to even guarantee something like that. I mean, think Iceland, think Cuba, think
That's the problem with land titles in general and how you record it, right?
Right. Yeah. And that always becomes an issue. So, to summarize, we've got an opportunity coming out of a technology that is still being understood, that is infinitely flexible. It can be as large or as small, as public or as private as the parties want it to be. And all you really need is an understanding of how to write the blockchain code and then put it out there and see how many other participants, and you define how many participants there are and what you want it to do, et cetera. Well, one of the manifestations of blockchain that I think I'd like to talk about now, if you are following along with the slides, is the smart contract characteristics and the key characteristics and ecosystem of a smart contract. And Joe, you want to walk us through some of these steps?
Yeah, I mean, we hinted on this a little bit earlier that a big part of it is that we're reducing the human factor, right? And I think one of the slides we've got an image of a vending machine. At its core, if you think about how a vending machine works, there's an offer and acceptance, basic contract fundamentals, but it's essentially transparent, it's self-executing, it's self-authenticating. Once it happens, you put your money in, you can't reverse the transaction. It's done unless, of course, it gets stuck, right? Right. To your earlier point.
So we won't need lawyers anymore.
Well, it's an interesting question. I mean, I think
I guarantee that the lawyers
I
figure out a way to embed
Right.
themselves in these contracts.
So, and I think the other point is that, and this applies in the Bitcoin implementation also, breach is very expensive. It costs a lot of money to actually break a contract. And you look at the example of the vending machine. But to your question about lawyers, I think the important thing to understand about smart contracts is that they're not actually legal agreements. So I think what we're starting to see, and we've seen it in the financial, some of the implementations, R3 did their new Quarter product. It essentially it supplements the legal agreement. So we have a legal agreement, you have your terms, and then what's happening on the smart contracts is it's actually executing on those terms based on the set of conditions.
Yeah.
Right.
Well, and that's an interesting point. You said as a given that these are not legal contracts. Legal contract is any offer and acceptance. Doesn't need to be in writing as long as there's consideration supporting the contract, at least under the English common law, and has been implemented in the U.S. and in most of the world.
Yeah.
And in fact, the Uniform Commercial Code, which took probably 30 years to finally be adopted by all the states in some form or other, but the Uniform Commercial Code requires the states to impute into normal standard contracts, standard terms that you can modify by a written contract, because they recognize that people don't always write things down. So I guess, let's probe a little bit that question. Why do you feel a smart contract is not a contract?
So I think in certain cases where there's a simple offer and acceptance, and there's a manifest dissent, just like an online contracting, you can have a legal agreement without something written, right? So if I'm selling physical property or digital assets that are represented on a blockchain, and you're able to verify that I own it, I verify you have the money to pay for it, whether it's in cryptocurrency or otherwise, we could do a transfer, and we could actually have an agreement. Well, when you look at something more complicated like an ISDA agreement, I think we're seeing implementations that the ISDA agreements are not going to go away, but we may actually be executing on certain terms in those agreements on the blockchain.
I think the market, just like it's getting with cleared swaps, it'll get bifurcated.
Right.
There'll be standardized terms.
And then you'll have a term sheet that'll be embodied in the blockchain.
Yeah. And to me, maybe I'm just not dancing the line too much, but to me, if I have a blockchain that turns on certain switches and selects certain options that are pre-specified, to me, that's a contract. I mean, in reality, I'm not sure that's different from payment system question, right? On Bitcoin. If I go and put on my blockchain that I just agreed with JP Morgan to buy $1 million of protection on IBM, and here's the price, and here's the trade day, and here's the termination day, to me, that's a contract. And I think the only embodiment of the contract is going to be on the blockchain. Maybe there's some record somewhere of what that contract means, right? There was some standardized terms that were incorporated and pulled in that were written by market, for example, that were pulled in. But the actual...
Well, so different than the protocol, modifications of all the ISDAs that happened a few years ago. It was deemed to be an offer and acceptance by their opinions that were written to support that blanket protocol.
Yes. And I'm sure on standardized stuff it will fine, but the problem is that there's a very large chunks of the market that aren't standardized in the swaps world, and won't be ever probably.
So in your example, sort of you envision sort of there being a master agreement, and then each one of these transactions an offer and acceptance, legal agreement under
the kind of thing, when you turn 18, you as a male, you register for the draft, and then you sign your master agreement for blockchain.
But they already, in some sense, they already have that. If you go and sign a confirm in ISDAland without a master agreement or a schedule, there's an automatic gap filling, just like the UTC.
Right.
It'll assume that the master exists with certain standard terms and a schedule in the same way, and boom, to boom, to boom.
Or it'll be like a DF terms agreement, which is the short form. In the absence of a master, we impute all these terms. We draw from the standard database.
Right. People will do that without blockchains, no problem. So I can definitely see you standardizing interest rate swaps or certain types of swaps of large liquidity volumes in standard terms, that the contract itself will be on the blockchain. The tricky thing is that, unfortunately, that's probably half the market. The other half of the market's so fragmented that it'll never work. And that leads to the human error problem of getting rid of your middle office. Good luck. When somebody comes to you and says, I want an interest rate cap with the following characteristics to my bank loan, and it's a customized cap. Okay, there's no way the automate's going to know whether that cap is right or wrong. Somebody's going to have to reconcile it. Where's the middle office?
Okay, so let's talk a little bit about blockchain and privacy. You know, I've heard blockchain contracts described as the millennial equivalent of the selfie that's posted on Facebook. So let's talk about, you know, how does that work, Joe?
Yeah, so I think this gets back to the point of there are an infinite number of ways to actually implement distributed ledger technology or the blockchain, and so there are going to be some implementations that don't lend themselves to putting obviously private data on the blockchain, and so what we're starting to see is implementations where the private data and information is not on the public ledger, whatever public means. And then we have side chains and other side databases where there's data that's being pulled in on a transaction-by-transaction basis when it's needed. And so if you look at something like financial data or healthcare information, it's not going to be on the public blockchain, right? But it might be on a side chain and be stored on, you know, individual parties' databases.
Exactly. So when I think about what we do at Global Debt Registry, you know, there's multiple levels of sort of data from a sensitivity point of view. So there's at the highest level, there's validation, GDR validation, that the loan is real, borrower is real, the ownership is real, that we have sort of validated that. There's the next level down, there's who actually owns it, which is clearly some sensitive information, and then the level below that is the actual personal information, the PII about the borrower and loan, which, you know, clearly you don't want that on any potential public blockchain or any really private blockchain. You know, we want to store that ourselves off the PII, off the blockchain. But the fact that the loans and the borrowers and the ownership's been validated, that is sort of data that should be widely accessible within the community, the permission community of investors, platforms, and lenders.
Yeah, it seems to me that as our audience today, investment management professionals, look at blockchain, they need to still deal with a 76-year-old statute, right, the 40 Act and the Investment Advisors Act of 1940, and then, of course, the 33 Act for securities and the 34 Act on exchange of securities. Has there been any discussion as to whether or not smart contract embodied in a blockchain is a security? Todd, any thoughts?
Not that I know of. But there's another thing, going back to security, that I was thinking about. If you were, for privacy, if you were Lehman Brothers, and it's a smart contract system on a repo, every bank in America might have been looking at Lehman and said, hey, wait a second, why is Lehman suddenly trying to repo out for cash every kind of security they possibly have? The entire market would have known immediately that Lehman would appear to be suffering from a cash crisis, right? Which they were trying to keep quiet. In the current bilateral market, you might have some success in doing that. In a blockchain market, people are going to know instantly that you're repoing all this stuff out in an almost desperate attempt to get cash, right? And I can see dealers not being so fond of that possibility. People getting information.
Well, it means they have a different data point that they need to work with and figure out how to incorporate it into their business model. I mean, if nothing else, this is a very resilient and creative industry that deals with, you know, new things like that. But going back to, you know, the touchstones of investment management and funds, a smart contract that, again, is merely dealing with price discovery, participant discovery, and availability discovery, but then has settlement somewhere else, implies there's also custody somewhere else. So we really haven't changed anything. We may have made telescope down T+3 to T+0, but we haven't changed the fundamentals.
Now, that may very well be true. I mean, we don't know where the market's going to wind up, how it will be built. But you're right, it might wind up being built in such a way that from the viewpoint of a fund and the custody rule, it doesn't matter. It'll be in the same place 20 system now.
as it is today.
Right.
But if, on the other hand, we're talking about a smart contract being a digital embodiment of the asset itself, so that it doesn't exist on somebody's custody books like at DTCC. Take George's example of, digitizing title to houses and then trading them in real time.
Well, Overstock.com has done this. Overstock.com issued preferred stock out of one of its subsidiaries, and apparently the share registry is a blockchain, which I believe public. I believe it's a public blockchain. And
this was blessed by the SEC. This was
Correct.
a public offering, an experiment that they did with Overstock to see if they could make it work.
correct. And I would presume that the SEC takes the view, which I think is a realistic view, that if you're buying and selling something on that public blockchain, you're buying and selling security.
Well, no, if it's the embodiment of a security that meets the Howey test or an investment contract that performs as if it were a security,
Yes.
then it's
Yes.
security. But if it's a blockchain for something that's not a security, like, pick an example, grand pianos.
I agree, but in the case of
Although it
Overstock,
might be a warehouse receipt. Maybe the argument is that the blockchain, evidence is something, and therefore it's like a warehouse receipt.
in the Overstock.com example where it's called preferred stock, I'm pretty comfortable that it is security.
Well, yeah, if you've conceded the point, and you say it's stock.
And I'm pretty sure the SEC in the Overstock example takes the position that all buys and sells in that blockchain are security sales.
Okay, so it's a security. Who's the custodian of it?
The blockchain, therein lies the interesting question. You're right.
Because under the Investment Advisors Act,
No.
I can't buy that because I need to be able to custody it.
But here's an interesting question, which I don't actually know the answer to, because that's the share registry. That's different from the custodian, right? We don't know where the shares actually sit. The fact that the share registry is a blockchain doesn't prevent them.
But you see, you're again going back to the breaking of the ownership between the actual physical asset and then the.
But you've already got that. I mean, because right now in the average equity, right, DTC holds a single piece of paper that says up to 1 billion shares of IBM sitting somewhere in their vault.
Correct.
They're the custodians for that, but the share registry for that is run by somebody totally different.
Agreed.
Yeah.
But that is the legal fiction that we have created in order to facilitate trading of shares.
And there isn't enough information I've seen on the example we're talking about to know whether or not there is a physical stock certificate sitting somewhere that's custodian or not.
It may not even have to be a physical certificate, but somebody has to step up and say, I am a qualified custodian and I am the qualified custodian of this asset. Otherwise, I don't see how you could put it into funds.
But can't that be something that's verified as part of the blockchain implementation, that you can verify that?
What Greg is getting at is when the 40 Act was written and the Advisors Act was written and other aspects of securities laws were written, they weren't designed with this kind of thing in mind. and over the years, there have been various things put together with Scotch tape and baling wire, and there's certain examples, like in the swap context, for example, on cash collateral, everybody knows doesn't fit terribly well with the custody rule, and there's a variety of issues there people have stared at. And I'm not talking about mutual funds, just even the private fund context, It doesn't work so well. And people know that, and the regulator knows that, and sort of wink, wink, nudge, nudge. It's close enough. We'll ignore that little issue over there. This stuff is so different than the way the market currently operates. You can imagine all kinds of rules and regs and precedents make no sense. And the question is, if the market moves in these directions, will they have to revise the actual acts themselves? I'm not talking about the rules. I mean, rulemaking by the SEC or the CFTC and whatever takes forever. But if you have to have Congress go and modify the underlying legislation, and that may take a while and involve a lot of contentious issues.
Yeah, but the lesson from this is don't assume that it's okay for a fund to hold this stuff because of this very fundamental issue.
Yeah.
The Advisors Act requires a registered advisor or someone who should be registered to have all of the assets in their fund or in a separate account held by a qualified custodian. And if we can't identify a qualified custodian, then this doesn't work. George.
So what's happening is that people have come up with new structures they refer to as distributed autonomous organization. which are not companies. They're not registered with the state. They have no legal structures, and who operate thanks to smart contracts where you own interest in a distributed autonomous organization. And as a DAO sells product and makes money, you automatically get credited to your cryptocurrency wallet, cryptocurrencies, and you can buy and share interest in these DAOs. So what's happening is that the whole world is building a parallel universe because they don't know how to solve these issues with securities, regulation, even judicial control of the blockchain and cryptocurrency space. They end up building a parallel one which is bubbling and is growing, while everybody else is arguing how to regulate this.
Well, it would seem to me that, our friends at the SEC who may be listening, there is sufficient authority under the Advisors Act and the 40 Act to write an exemptive rule whereby they would exempt this type of asset from the qualified custodian rule if you meet certain verification criteria, like a private ledger, for example, would need to be verified by 30 nodes. Pick a number, right? Around 5 nodes, I don't know. But, where you know that it exists and where you can have some degree of certainty that it's not in the control of the advisor, because that's what this is about, right? Preventing fraud and defalcation. So let me turn to Charlie for a second here. You guys deal with global debt registration. That's the essence of your business. How do you see that being tied or changed by blockchain?
So, at the moment with online lending, you've got the validation of the loans and the clearing of the loans being done by the platforms themselves. I think from a sort of a trust perspective, and as that industry grows up, they're increasingly looking for an independent source, as well as the ability, per comment earlier, to enable secondary market and securitization to be able to have a permanent record of the independent validation of the loan in terms of the real loan, real borrower, and clear ownership sort of multiple times. So having that accessible, through a distributed ledger, which will still require a degree of sort of governance and oversight and standards in particular, is a growing need. So we're not on the blockchain today, but we're increasingly getting asked by clients, particularly the large banks who are exploring this in parallel in some similar sort of use cases. Could you put this on the blockchain? Per the comments earlier, there's a relatively small number of players and a relatively low volume of trade, so to speak, today. So it actually would appear to lend itself reasonably well to that use case.
But these are loans that presently do not have CUSIP.
Correct.
Okay, so they're very small, number one. Number two, they're not publicly traded presently. There's no registration statement.
Right.
And there's really no record of them. So this is the Ecuador real estate opportunity, right? It's a brand new industry with brand new instruments.
Exactly. So it is a great opportunity to adopt some new technology to support, a future sort of infrastructure for this new way of lending. So,
but the idea here is that these assets, you're thinking of the blockchain not as an exchange medium, but rather as the embodiment of the contract.
Yeah, as we were talking earlier, I think the blockchain has a role in sort of improving trust, certainty, as well as the sort of speed and efficiency and cost reduction. I think in the case of online lending, it's more around the trust and the certainty and enabling that sort of the ecosystem to have the permanent records of who exactly owns this and is it a real asset for sure, and is all of the borrower information, loan information correct, and when was it validated against which sort of sales and securitization activity, and having that sort of certified by an entity, seems to be a requirement for, certainly for more mature investors to participate in that market. And the marketplace lenders are trying to attract more mature, sort of risk-averse banks to invest, who inevitably require, greater degree of certainty around the underlying asset.
Now, with those loans that we're talking about here, they tend to be unsecured.
Yeah.
Okay. Is there any expectation that a secured loan, something that's backed, for example, by real estate, could also, populate the blockchain where the terms and conditions of the security are also embedded into the contract?
Absolutely.
A traditional smart contract, right, Jim?
Yeah.
That's something that could be done.
Yeah. Yeah, I mean, it's a slightly more complex implementation, but absolutely, delivers significant value.
So that opens up a whole other opportunity. So we have about 5 minutes left, and if there are any questions, please feel free to submit them. We've been monitoring here, but we haven't seen any. So I'm going to ask one, and we're going to go around the room here. Assuming an unlimited budget and an unlimited will to proceed, in your view, George, when would we have a system where blockchain can actually be the embodiment of the transfer of legal title of securities, where the participants, hedge funds, mutual funds, or other asset managers are in a position where they can reliably buy, sell, and have the major share of their portfolios in these types of digital assets?
So the question is, when will the majority of securities be exchanged on the blockchain, assuming infinite everything?
Yeah, assuming infinite will and infinite money.
From a technology point of view, I think technology is the easy answer. I think that 6 months, 12 months, a year, 2 years, that's kind of timescales. I think the difficult part is not that. I think the difficult part is the incentivization to make these people participate and how you integrate this new process in the existing processes to displace it. So I think it's going to happen instead of having existing securities or shares being traded on the blockchain. I think instead, new issuance of new type of assets like these DAOs will start trading on the blockchain. And the blockchain will be a majority of the securities trading and settlement when DAO valuations as a sum will be higher than the valuation of the New York Stock Exchange complete cap.
Do you think timeline, a year?
No, I think for technology it could be a year. I think timeline, tens of years.
Tens of years.
Yeah.
Joe?
I think it's difficult to answer the timeline. I think before we get there, we have to ask the question of, and this is what the banks are doing right now, is what problems do we have? What are the challenges that we have? And what implementation of distributed ledger could solve some of those problems? And I think what we're going to see is some problems get solved sooner than others, like any technology. And I think as they spec this out, we might see over the next 2 years financial institutions starting to roll out flavors of distributed ledgers to solve certain problems. Will we get to the point 10 years from now, 15 years from now, where all securities are traded on some form of blockchain? I think it's possible. But to put a timeline on one particular implementation, I think is very difficult because there are going to be so many different flavors of distributed ledger technology that we're going to see.
So George is tens of years.
I think we're going to start seeing commercial implementations of distributed ledger technology in the next 2 years. Whether or not actual securities are traded on it, I think that's probably not 2 years. It's probably further than that.
I think there are markets like repo, which we know has a lot of operational issues, and sec lending, what I'll call large wholesale markets that are fragmented, even though they're very large and they're very wholesale. And there'll be a lot of pressure, I think, both on a regulatory risk level with repo. I think on sec lending, I think people need to borrow for shorts or realize it would be a lot cheaper and a lot more efficient, and they get better coverage if you had some sort of an inter-dealer network on a blockchain. I think those things I wouldn't be surprised in 5 years. I think things like normal equity stock, I'm not sure it will ever move over because it's not clear to me that the advantages in performance or whatever are worth trashing your infrastructure. But that currently exists, that functions relatively well. And that may be the real deciding factor. If the current infrastructure works and is effective, there's no need to replace it this week or this week or next year. But if you're in repo or sec lending or if you're in the area that George is talking about, where there isn't an existing infrastructure really, yes, it may be much more attractive to do blockchain and do it soon.
Charlie.
So I'm going to go broadly in line with Joe. I think we're going to start to see a few implementations adding value over the next couple of years, but I think wholesale adoption, will be a longer. I think whilst there's still technology issues to work through, I think George's point around sort of incentives and human incentives and business incentives, I think is a bigger barrier generally to adopting new technology. So actually getting the relevant parties to agree sort of how this technology should be implemented in terms of, what rules in smart contracts, what data standards, who gets the key, what's private, what's open, et cetera, et cetera. Those are the sorts of issues that take humans a long time to work through over and above the sort of the technology. So I think we've got a little way to go, but I think we'll see some value coming through over the next few years, and I think it's going to be one of those technologies where the best implementations will be pretty much invisible for the end user. I think it's under the covers. This isn't sort of something that a user is going to be particularly aware of. They'll just start realizing the benefits of improved efficiency, speed of settlement, or better trust. Which again is pretty invisible, but fewer problems associated with some of the potential fraud issues and so on. So I think that's important to recognise. This isn't going to look and sort of jump out of the screen at people. This is going to be a pretty hidden technology, which often the best technologies are hidden under the covers.
Yeah. Well, the advantage of being the moderator is I get to go last, and I'm going to be much more bullish than my colleagues here. I think within 2 years you're going to see the nose of the camel under the tent. You're going to see trading in previously illiquid instruments move to the blockchain, and it's going to be contractual embodiment of the asset being transferred. I think you're going to see both the SEC and the regulators line up in order to lead this charge, because they have the opportunity to rewrite the rules in the way that they want them rather than react. They reacted to crowdfunding. Congress caught the regulators unawares with the Jobs Act. I don't think they want to see that happen with this, and I do think that you're going to see the regulators take the lead here. We did have a question that came through right near the end here. I'm curious as to who guarantees security in these transactions. What safeguard, if any, are implemented to stop hackers from mining both the Bitcoin and private information in these transactions? Who guarantees security in these transactions, George?
So there's two parts. Who guarantees that hackers cannot take your Bitcoin? That's pretty much relying on the fact that it's mathematically very, very hard, and it's a lot of computing power to decrypt encrypted messages. So it's a bet that it will take more than the age of the universe with a brute force attack, to decrypt the keys you need to transfer the Bitcoin from your account to another.
But that means if I've been sloppy with, my keys,
correct,
then I can lose everything.
Correct.
Okay.
Now, the second part of the question is the private information. Now, that's much harder. People may remember online supposed anonymous drug market on the darknet,
right?
Where the FBI and the police caught people. People leave all kind of tracks, IP addresses, what pages you went to, where you initiated your transfer from, which IP address, how are the messages transferred. And if you collect all of this information and do statistical analysis, to my knowledge, it hasn't happened yet, but it is far from being hacker-proof or anything like that. So even though you have an anonymous key that's encrypted, people may still be able to figure out the address of the computer where this transfer initiated from. And by looking back the address with your internet service provider and the phone book, looking up your name, your address, your Facebook profile, LinkedIn profile, and all of that.
Well, thank you to my panelists. Very, very interesting discussion. And we shall see if any of these predictions come to pass. We'll see you next month. Topic hasn't been decided yet, but if you ever have any suggestions, please feel free to send it to me, NOWAKG@pepperlaw.com. Have a great day, everybody.